Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today, and as always, send your email questions to Brian Rezny at ReznyWealth.com. Rezny Wealth Management is a fee-only fiduciary money management firm. What does that mean? We're not an advisor. We're not a Wall Street firm, we're not an insurance company, and we're not a bank. We're an actual fee-only fiduciary money manager. We actually manage your money, unlike an advisor, and we actually legally work in your best interest 100% of the time as a fiduciary. Unfortunately, the vast majority of investors are working with an advisor who is really a salesperson who is required to sell the products that that bank or Wall Street firm manufactures. And really that advisor is pushed and has to sell to you, the unsuspecting investor. And that's really sad. If you want to find out more about real money management and fiduciary money management, go to ReznyWealth.com. Check out our website, download any of our groundbreaking reports, and sign up for instant email alerts. You'll be glad you did. Today's topic, a little bit about the markets and the economy, and of course we're firmly into 2021. I want to talk about bubbles, investment bubbles in general. Investment bubbles, they come in a lot of variety. We're going to talk about that. But ultimately what happens is you, the investor, if you get involved in any of these bubbles, it's going to be really bad for your overall, not only portfolio and risk, but ultimately your long-term retirement security. I've been managing money well over 30 years. I've seen a lot of bubbles come and go, and honestly, we have bubbles every single year in all aspects of the market. Not just the stock market, but we have bubbles in the bond market, which is probably the biggest bubble today, which I'll talk more about. The stock market, real estate has bubbles from time to time. There's all kinds of bubbles. Not the whole market, or not all investments at once, but there are often pockets of these. The big key for you, the investor, is simple. Don't get involved in bubbles. Things that are grossly overvalued. I'll take you back to, let's go back to 2006 and 7. If you remember the real estate boom and bust in the U.S. and other parts of the world, but mainly in the U.S. This is when people were buying homes. They were buying rentals. They were buying anything real estate, and they were paying top dollar and premiums for the value. And what happened? That bubble eventually burst, and it may have taken a year and a half to 2 years as it built up speed and became more overvalued. But investors who got invested in real estate lost in a big way. We had a lot of phone calls into our office in 2008 and 9 and 10 from people that wanted to be clients of Rezny Wealth Management that lost most of their money in real estate because they bought 4 or 5 spec homes with no money down, had to pay mortgage payments. These individuals, unfortunately, the vast majority we could not help because they lost most of their money. So again, if something is too good to be true, if returns are so astronomical with a certain investment, whether it's real estate, a bond, or a stock, or any other investment asset category, you should really have pause and really think about what you're getting yourself into. I often hear this from investors. This time is different, Brian. And I'll tell you what. Managing money again for over 30 years, it's not different this time. Bubbles come and go, and eventually they will pop. So let's talk about, is it different this time? They said it was different in the real estate boom and bust in 2006 and 7, that real estate only goes up. Folks, we've had many real estate booms and busts over the last 100 years, and it's not different. Parts of the stock market boom and bust. Remember 2000? Only technology could go up. It's never going to go down. And guess what happened? People overloaded the boat. They kept jumping on because, hey, this did the best, and what I have didn't do as well, so I'm going to sell that, and I'm going to buy more of what's grossly overvalued, which was technology stocks back in the early part of the 2000s. Unfortunately for investors, a lot of them lost either a lot of their money or most of their money, and that's very unfortunate. But let's talk about, when do bubbles actually pop? There's not a bell that goes off. What's going to happen is, Investments are bought by usually professional investment managers like Rezny Wealth Management. Not that we always get in at the bottom, but we do a lot of research and looking at valuations. There needs to be a catalyst for any investment to go up. Once we've done our research and we look at an investment category, let's just say it happens to be oil today. In fair disclosure, we do own positions in oil, but we bought them very cheap. Now, we've done a lot of research on why we feel oil should go higher over the foreseeable future. There's going to be a point now where the small investor starts to pile into that position, and they pile more and more. And all of a sudden, you see a chart that kind of goes straight up, and it could last 6 months, 12 months, 18 months before eventually all the small investors are in, and they keep adding more to their positions because it's doing so well. And then that bubble pops and it goes down. But the small investor, what do? They don't sell immediately because, I got to wait till it comes back because I bought at the top and maybe it'll come back and go higher. But it goes a notch lower and a notch lower. And eventually, most individual investors that we've seen, and based upon no real research or strategy, unfortunately, that's the do-it-yourself investor most often, what happens is they ride it all the way down to the bottom like they did technology and real estate in the last two bubbles. And it usually takes the average investor 3 to 4 years till they realize they've lost a significant part of their money, and then they start to realize it's probably not coming back, and then they sell at the lows, and they repeat the process again and again. So again, every bubble pops. It may take a little bit of time, but don't get caught up in overvalued assets of any kind. The biggest bubble today, let's talk about that. In our opinion, based upon real hardcore research, and again, managing money for well over 30 years, the bond market in general, in our opinion, is the biggest bubble. The lowest rate of return on a yield standpoint, with really the biggest risk. If interest rates move up, remember, bonds go down in value. And when I've talked about this at the beginning of the year, interest rates are slowly moving up. They're not going to move up to Jimmy Carter days by any stretch of the imagination, but they're going to move up a little bit. Even subtle movements up in interest rates at these low interest rate levels will cause bond values to drop drastically. Take a look at the 20-year Treasury, government treasuries, supposedly the safest investment in the world. They're down 8 to 10% year-to-date negative. Wait, if that's a safe investment and bonds are supposed to be safe, how is it down 10%? Simple. Rates have moved up a little bit. We think rates have more upside on the interest rate over the next 6 to 12 months than they do on the downside. So bond investors, if you're in the wrong kind of bonds, and remember, there's different types of bonds. Duration, maturity, types of bonds, corporate, high yield, government, things of that nature. And there's different bonds that may be appropriate in the portfolio, but I will say this. Most of you investors, when we have new people call our office to manage their money professionally, most of you have an over-allocation to bonds, way over-allocation, and the wrong kind of bonds. So bubbles pop. Make sure you're not involved in those bubbles so that hopefully your portfolio lives to fight another day. Let's talk about the herd mentality. Herd mentality is simple. You try to convince others to do what you're doing. Okay? And it's real simple. I'll give you a real life story. We had somebody that we talked to that back up sometime last year when we really had the COVID virus hit full blown and the markets were going down, basically felt, the world's coming to an end. He tried to convince his friends that you should be selling your stocks because, hey, the world's coming to an end. He wanted to justify his bad decisions with his friends and family members. Unfortunately, some of his friends and family members didn't understand what the herd mentality means and believed this father, and ultimately they all sold their investments and went to cash at exactly the bottom of the market, let's say March of last year. Herd mentality, don't get involved in it. It's trying to convince others to think on a particular topic that is probably wrong and in the wrong direction. News hype from the internet. This is another big one I see a lot today. We get repeated emails and questions on my TV and radio shows from investors who read these crazy news headlines from weird internet sites, or they get these emails about investing, and they basically look at this hyped up news about how the dollar's not going to be the dollar, buy gold now, things of that nature. Folks, 80 to 90% of what you're going to read on the internet, or probably what shows up in your inbox, in your email, is probably hype and baloney. Don't utilize that in your investment process. Hardcore research. My firm spends a lot of money every year on real research. It's not free stuff off the internet. It's called spend a lot of money on hardcore research. The stuff you're reading for free on the internet is probably sales propaganda to get you swayed one way or the other, to get that herd mentality to buy into the thesis of gold or some other crazy asset that probably should not be in your portfolio. The other big one is this: chasing what is hot now. Investors like to chase what's hot. What that means is at the end of each year, all these publications will print, here's what did the best last year. Guess what the individual investor does? They jump into that hot investment that then cools off and often deflates 30 or 40 or 50%. Don't chase what's hot. Do a lot of hardcore research. Buy what's of value that has a catalyst to go up. That's your best opportunity. By the way, we've got an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. The true cause of poor investment returns and why your retirement portfolio is at risk. Go to ReznyWealth.com for dates and to sign up for our upcoming webinar. You'll be glad you did. It will be a game changer, how you look at investing, how you secure your retirement, and how you really secure the advice you're going to receive going forward. Go to ReznyWealth.com. I'm going to take a quick break. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make: being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report: Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back. I hope you're enjoying today's program. As always, go to ReznyWealth.com. Check out our website. We've got free reports you can download instantly. You can sign up for our upcoming webinar that we have coming up next week. You can also send us email questions, as always, for today's show. Send them to Brian Rezny at ReznyWealth.com. And my firm has been managing money well over 30 years. One of the things that we enjoy most is helping you pre-retirees and retirees properly manage your wealth without the conflicts and the sales of a Wall Street type firm, a bank, or an insurance company. If you've got $1 million portfolio or greater, call my firm during the week for a consultation if you'd like to discuss our money management services. Remember, Rezny Wealth Management is a fee-only fiduciary money manager. What does that mean? We're not an advisor. An advisor really is a salesperson that works for a Wall Street-style company, bank, or an insurance firm. A fee-only fiduciary money manager legally works for you, and we actually manage your wealth, unlike a set-it-and-forget-it mentality that you get from a so-called advisor, a salesperson. George in Fort Myers: can RMDs, and that's a required minimum distribution, folks, be taken from a 401k rather than an IRA? George, excellent question. It can. So let me explain. Let's say you have $100,000 in a 401k plan and you have $100,000 in an IRA, and you are at that magical age now of 72. You have to take both of those two accounts in aggregate, add them together to do your calculation for how much you need to take out. And let's say that amount is $20,000. You could take 10 from one account and 10 from the other, or you could take 20 from one account and none from the other, but you have to take out the minimum required based upon the aggregate of those two accounts. But either account would be fine. But again, when you're 72, it is mandatory to start taking distributions from a qualified plan if you're retired. David in Cape Coral, Florida: great information. As bad as annuities are, is it worth to take the hit, redeeming them and reinvesting the money in a more productive investment? David, I wish more people would ask questions like that. So the first thing is this: annuities in general, all annuities, whether it's an equity index or a variable annuity or anything in the middle, annuities are complete garbage. They are junk. They're expense ridden. They have surrender penalties that insanely lock your money up. And you're going to get ultimately lousy returns, probably with more risk. Why is that? Because expenses. As an example, let's take a look at a variable annuity. The typical variable annuity we've looked at and reviewed at our firm, and we've looked at literally hundreds over the years, has an annual expense ratio often over 3.5% to 4.5% a year. Well, that comes against your return. Lousy investments in a lot of those products, high expenses do not equal great returns. So, David, this is what I will tell you to do. Take a look at the annuity you have. How long is the surrender penalty? What is the percentage of the surrender penalty? What is the annual cost structure of that annuity? How long will it take to break even? If you canceled it today and it took a 4% hit on surrender penalty, but your expense ratio is 4% a year, well, your break even, let's say, is less than a year. So what you'd probably want to do is say, hey, if it's less than a year and I got 4 more years to keep this lousy annuity, maybe you should take the surrender hit after that analysis and move on to greener pastures. Expenses do matter. Annuities never belong in any portfolio, but the people that sell annuities are so-called advisors, people that are selling products they are required to sell for the biggest commission for them and their firm. They don't care at all about you, and they're not fiduciaries, and they're not fee only, and they legally do not work for you. Bev in Miami, Florida. With bonds possibly going to tank and interest rates so low, where can non-stock money be invested? Bev, excellent question. First off, rates are already slowly moving up a little bit. We don't expect rates to skyrocket, but move up a little bit. Bonds will do very poorly in this cycle. And generally speaking, over the next decade, bonds are going to have abnormally low rates of return. Not a great place to keep long-term money. But where can you invest non-stock money for a decent return? You can't. And reality is, if you're trying to be conservative with some of your money, don't expect to make a lot of money. If you want to be conservative, you can keep it in a high-grade money market account, a floating rate type money market, maybe a short-term CD. You're going to make low rates of return. There's no place you can invest money today that is safe and conservative that you'll probably make much more than 1.25% on your money. That's going to be it. Anything above those kind of rates of return, or if somebody's pitching you that, is going to have some degree of long-term volatility with the potential for a higher return as long as you're in the right area. Ed in Naples, Florida. My advisor wants me to buy an index annuity for my IRA rollover. I'm not sure. What do you think? Ed, do not do it. As I talked earlier, annuities are complete junk and garbage. They are sold by so-called advisors who are not fee-only fiduciary money managers. An annuity has insane lockups and insane expense ratios. Insane. Do something different with your money. If you want a conservative investment, then go and buy a CD at the bank. You'll probably make a similar return. Equity index annuities, even though you're probably pitched something much different on return, reality is this. And I've looked at hundreds of these products, by the way, over 30 years. You will be lucky on an equity index annuity over the next 10 years to average 1 to 1.5% a year. You'll be lucky if you do that. You can make a similar rate in a safe CD at the bank with liquidity. But these things are pitched by people who are really just salespeople with a fancy title. So again, don't buy an equity index annuity. They're garbage. Go to my website, by the way, reznywealth.com. Download our groundbreaking report, Why Annuities Are Dangerous to Your Wealth and Retirement. Read it twice. Educate yourself before your money is taken to the annuity woodshed by a salesperson that doesn't care about you one bit. All they care about is the big fat commission that's going to line their pocket and strip your retirement of true financial security. By the way, if you want to learn how not to make bad mistakes with your money, I've got an upcoming webinar, and it's free. It's perfect for your pre-retirees and retirees. The disturbing facts most investors are shocked to learn. The true cause of poor investment returns and why your retirement portfolio is at risk. If you want to learn more, go to reznywealth.com, click on the workshop tab. Sign up for the workshop. It's free. It will be a game changer on how you look at investing going forward, how you secure your retirement, and where you get the real advice that's going to help your portfolio ultimately go in the right direction. As always, go to ReznyWealth.com, click on that workshop tab. And for you larger investors, Rezny Wealth Management is a fee-only fiduciary money manager. We manage larger portfolios of $1 million and greater. If you're realizing your so-called advisor is no more than a salesperson in a set it and forget it mindset with massive conflicts of interest, remember, not one bank, not one brokerage firm or Wall Street firm, not one insurance company, none of them are fee-only fiduciary money managers. The only kind of firm you should entrust your money to is a fee-only fiduciary money manager, a firm that legally works for you and actually manages your money without the conflicts of those typical firms. Folks, I'm going to take a quick break. I'll be right back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back. I hope you're enjoying today's program. Send your questions to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. And by the way, on the weekends, in addition to my TV show, I have a live radio show every Sunday morning from 10 to noon throughout Southwest Florida. Go to ReznyWealth.com for times availability and make sure you do listen. You'll get a lot of great information. And we do take a lot of other questions on that show in addition. Denise in Naples, Florida. I purchased NVIDIA stock at $18 a share, and as you know, it's significantly increased. It's hard to sell a stock since it's doing so well. It's hard to know when to take profits. Your thoughts? That's a great question. So typically what happens, Denise, is this. Investors will buy a stock without really, to be brutally honest, doing any research at all. They'll buy it because, oh, I heard it went up a lot, or I heard they make this or make that, or I've heard of the company and I kind of know it, so I'll buy it. The key is this. Whenever you buy a stock, make sure you do thorough research. And once you buy that stock, you need to continue doing research every single day on that stock to make sure it's doing the right thing. You may buy a stock today and keep it for 20 years. You may buy a stock today and sell sometime in the next year or 6 months. It depends if that stock's doing what it's supposed to do on earnings and growth and basically meeting the goals and objectives you set forth. So this is what I tell investors. When you buy any stock, before we buy a stock, we already know why we're going to sell it. We know what has to happen and the reasons that are going to transform for us to actually sell a particular stock. So first off, never buy more than 5% of any one individual stock. Never more than 5% of your portfolio in any one individual stock. And what I would say to you is this, when that 5% grows to 6, trim 1% off so it's back down to 5. This way you're always taking profits and often selling and locking in a profit on a stock that may start to become grossly overvalued as part of the portfolio. It makes common sense. So ultimately, when you buy a stock, do your research. When the reasons you bought that stock change or start to change, that would be a reason to sell the whole position. But always be in tune of trimming a position over time. Mark in Naples, Florida. What's your thought on Bitcoin and gold and silver ETFs? Mark, I've had a lot of questions on Bitcoin. So Bitcoin is really a speculation trade. If you want to speculate, great. If you're going to put money in Bitcoin, I would not put much at all. Maybe 1% if you think it's going to go to the moon, but this is going to be a highly volatile speculation trade is the bottom line. Bitcoin is basically a cryptocurrency. Cryptocurrencies have already come and gone over the last decade. There's over 5,000 cryptocurrencies right now around the world. Bitcoin is not the only cryptocurrency. There's going to be a day where our government, and by the way, China's already working on this and other governments, where they're going to have their own cryptocurrency. What's that going to do to the value of Bitcoin long term if that happens? My guess, it's going to drop significantly in value. All it is a means of payment or exchange of money. It's like a dollar bill. So while there's a lot of thesis or reasons why Bitcoin should go up, a lot of those, in our opinion, are really unfounded. It's a speculation. Do not speculate with large parts of your money, or you will be happy. As for gold and silver, we do not own either of these, and I would not touch these with a 10-foot pole. The economy is recovering. Interest rates are slowly moving up. That's bad for gold and silver. And ultimately, there's other asset categories and other investments, in our opinion, that are much superior on a performance standpoint or opportunity standpoint going forward. There may be a point in time for gold and silver. It certainly is not right now, and I cannot see any time, at least this year, that will come back in vogue and be part of a portfolio. Trevor in Cape Coral, Florida. What are your thoughts on small cap stocks? Hey, that's another great question. We actually own small cap in our portfolio. So as we have what we call the reinflation trade, things are coming back in the U.S. economy, we've added small cap back into our portfolio after we trimmed positions a period of time ago. But small caps are a great reinflation trade. They're actually fairly cheap right now. They're outperforming the large cap sector. That could change at any time. And our positions in small cap, by the way, can change at any time. We own small cap now. I firmly feel we will probably own at least through the end of the year, but it depends how fast it moves up, how overvalued it potentially becomes, and what we really want to do is make sure we own assets that are not grossly overvalued. So we may trim position throughout the year, but we do like small cap in general. Joseph in Orlando, Florida. In general, what is your opinion on the current real estate market? I think the real estate market is fine and dandy. There's parts of the real estate market that are overvalued. If I look at commercial, there's parts of this country that commercial real estate is probably not going to do great, especially office type buildings, let's say in New York is a great example as people exit that. So what I would say is you really need to look at each individual segment of the real estate market. Real estate is in some areas is grossly overvalued and not a great opportunity. Other areas it's more fairly valued. You need to pick your pockets. By the way, we've got an upcoming webinar. Go to ReznyWealth.com. Check out our webinar tab, The Disturbing Facts Most Investors Are Shocked to Learn. The true cause of poor investment returns and why your retirement portfolio is at risk. Go to ReznyWealth.com for dates and to sign up. You will ultimately be glad you did. You know, we're getting close to the end of our show. One of the things I want to stress to every investor is proper money management is vitally important more than ever. If you're one of those investors where you're realizing the advice you're getting is not working, your advisor is more of a salesperson than a real money manager. Remember, real money management, real advice is the difference Rezny Wealth Management provides. Ultimately, if you're concerned about the way your money's been managed and you're tired of bad advice, tired of the conflicts from a Wall Street style firm that really undermine your financial security from that so-called advisor, sad fact, most advisors are really salespeople that sell the products their firms require them to sell. No real advice at all, no money management, sales. That's not the way your retirement nest egg should be properly handled. Rezny Wealth Management, fee only fiduciary money management. We actually manage your wealth and we legally work for you. Go to our website, ReznyWealth.com. If you want honesty, integrity, compassion, and competence, that's the difference my firm provides every single one of you investors. Make sure you have a safe and profitable day.